Today we're going to be talking about the tax triangle. It's often misunderstood the way our money is taxed when we take withdrawals out of our accounts. So I'd like to explain it and break it down so that it's more digestible. And then maybe if we understand that, we can then make some changes as to how we're saving our money today and understand the impact of that choice for later on. So ultimately, our money can be taxed in one of three ways. The first way is it can be fully taxable at both the federal and state tax level. So what kind of accounts have that taxation? Well, typically there are pre-tax accounts, meaning traditional 401ks, traditional IRAs, essentially any account that you haven't paid the tax on the contribution. So think about it. Our traditional 401ks, our traditional IRAs, when we put money in, we're most of the time getting a deduction for that contribution. We haven't paid the tax. They're pre-tax accounts. Yes, the money grows tax deferred as it's sitting inside of the account. And then when we go to take the money out, when we're 59 and a half or older, the full distribution, every dollar is going to be taxable to us at whatever the federal and state tax limits are at that time. So a lot of people will say to me, well, Sarah, that's okay because I'm going to be in a lower tax bracket when I'm in retirement. So I want that deduction today and then I'll pay the taxes later on. And that has been a traditional way of thinking for most Americans, as most Americans have saved their retirement assets in these pre-tax accounts. But if we think critically and we ask ourselves the question, where do we think the future of taxes will go? It becomes a little bit more muddled than what the traditional way of thinking has been, meaning, where do we think the future of taxes is going to go? Well, right now, and I know, believe me, it doesn't feel like it, we're actually in a very low tax environment. And do we think that taxes will continue to go even lower in the future? Likely not, right? Probably not. So understanding that, thinking that taxes will likely go up in the future, there's no guarantee that when I'm in retirement, not earning an income, that I'll be in a lower tax bracket than when I was working, especially if tax rates go up, right? So understanding that we have no control over what the federal and state tax limits are will help us realize that we may or may not be in a lower tax bracket in the future. Additionally, these accounts, these pre-tax accounts, have required minimum distribution. So when we're 73 or older, that's the current required minimum distribution age, we're forced to take distributions. The IRS sets the limit, and every year that percentage increases for the distribution that you have to take out. You are forced to take a percentage out of the account and ultimately pay the tax on that distribution as well. So that becomes unsustainable at some point, right? I say it kind of facetiously, but it's the IRS's intention for you to liquidate these accounts and pay the tax before you pass away. You've enjoyed tax deferred growth and never paid tax on these dollars for all of these years. They want you to start taking those distributions and pay the tax and ultimately liquidate the account. So knowing that's unsustainable, we realize that we're not really in control over these accounts. Not only do we have to force these distributions, but we also have to pay the tax on those distributions as well. And the last thing that I'll say about these accounts that are taxed at the full federal and state income levels is that these distributions will impact your Medicare premiums. So when we're 65 and older, we go on to Medicare, that's our health insurance. And Medicare, the price that you pay is based off of your taxable income from 2 years prior. So for Part B and for Part D, we're going to have to pay a premium monthly, and that monthly amount is determined by our taxable income from 2 years prior. So what's taxable income? Distributions from our pre-tax accounts. That's taxable income to us. Okay, so understanding these three things will help us realize that we want flexibility. We want money that's going to be taxed differently. So we have this one type of account, the pre-tax. What are some other ways that our money can be taxed? Well, we have a second type of an account that's called a non-qualified account. Non-qualified accounts are simply accounts that are not retirement accounts. They don't have the words IRA or 401k in their titling. So think of maybe a mutual fund account or a stock account or a joint investment account that you may have. When you hold those investments for 12 months and 1 day or longer, you enjoy the long-term capital gains rate. The long-term capital gains tax is a discounted tax compared to our ordinary federal and state income tax rate. So it will always be lower. So if I've held the asset and I go to sell, I pay tax on the earnings at that discounted rate. If I don't hold the asset that long, maybe I'm day trading or I sell something that I've only held for 6 months, for example, if there's a gain, I'm going to pay ordinary federal and state income tax on that gain. But so that's more of a discount. Unfortunately, these non-qualified accounts don't get the benefit of tax deferred growth like our retirement accounts do. So we have to be paying tax as these accounts are growing on the dividends, any gains realized, and the interest in those accounts, but it's still a discount. And then the third, more preferred account is going to be potentially tax-free, right? Roth IRA, Roth 401k, HSA, cash value life insurance. These are accounts where when we take a distribution, we pay no tax. No tax, right? So knowing that we have these 3 separate kinds of accounts, I want to try and have this tax-free pool be as large as possible. Now, how do we get money into these accounts? Well, more and more employers have Roth options in their employer plan. So Roth 401k, Roth Simple IRA, there's a lot out there now. And if you have that, there are no income restrictions. Anybody can contribute to a Roth account through an employer plan. So if you have a Roth 401k, take the time to investigate that because you can put the money in, no deduction for that contribution, but my money's gonna grow tax deferred, and when I go to take the money out in retirement, completely tax-free, no required distributions, no impact on my Medicare premiums because it's tax-free, right? So these are accounts that I wanna consider. Now you can also do a Roth IRA that's outside of an employer plan. Roth IRAs do have income restrictions, so if you earn over certain thresholds and they change that number every year, you're ineligible to contribute. However, you can always do backdoor where you contribute that money to an IRA and then move it over to a Roth. It's a silly motion that they make us go through, but you still have the capability of doing that. So this is something that we would want to consider. And at least understanding the way our money is taxed is something that's important for us, because then we can see the balance. What do I have? Is most of my money going to be taxable to me? Do I want to give myself flexibility? Do I want to lower my required minimum distribution burden? What are the things that are important to me in understanding? So that's what I think is important for us to really work through. What's important to us? What flexibilities do we want to have? Because we have money that will be taxed differently, right? So if you need any help walking through these things, obviously feel welcome to reach out to us. We're always happy to talk.